How to backtest with limited historical data. Have you ever wondered how to backtest your trading strategies when you do not have enough historical data? This is a common challenge for traders, especially in options trading and swing trading. Let's break down some effective strategies to tackle this issue. First, it is essential to use the available data efficiently. Focus on the timeframes and market conditions that are most relevant to your strategy. If you have a few years of data, try to include periods that cover different market environments, such as bull, bear, and sideways markets. This will give you a better understanding of how your strategy might perform across various conditions. Next, simplify your strategy parameters. With limited data, it is easy to overfit your strategy to the small dataset. Keep your entry and exit rules straightforward. Avoid using too many variables or complex conditions that requiring extensive data to validate. Another approach is to simulate trades at different price points. When backtesting options or stocks, you can simulate trade executions at various price levels, such as open, high, low, or close prices within your available data. This helps you approximate how your strategy might have performed under slightly different conditions. You can also take advantage of multi-leg options backtesting tools. Some platforms allow you to backtest multi-leg options strategies even with limited historical data. By inputting parameters like strike price, expiration, and contract quantity, these tools simulate trade outcomes based on the historical prices available, providing you with profit and loss metrics. Consider using rolling or walk-forward testing as well. Instead of testing over the entire limited dataset at once, divide the data into smaller segments and test your strategy sequentially. This approach can help you understand how your strategy adapts over time and reduces the risk of overfitting to a specific period. Incorporating paper trading or simulated forward testing can be beneficial too. Combine your limited historical backtesting with forward-looking simulated trading in real time or on a demo account. This allows you to validate your strategy under current market conditions while compensating for the lack of extensive historical data. If direct historical data for your target security or option is limited, consider supplementing with related market data. Using proxy data or correlated instruments with longer histories can provide additional insights. For example, you can use underlying stock data to infer how your option strategy might perform. Lastly, it is important to understand the limitations of your data. Recognize that limited data reduces statistical confidence in your backtest results. Use backtesting as one of several tools in your strategy development process. Combine it with fundamental analysis, market knowledge, and ongoing strategy refinement. When it comes to swing trading opportunities with options, backtesting can help you evaluate how your entry and exit rules would have performed historically. Even with limited data, you can test simple options strategies like buying calls or puts around key swing points. Inputting parameters such as days to expiration and strike delta into backtesting tools allows you to see potential profit and loss outcomes over your available timeframe. By following these strategies, you can effectively backtest with limited historical data and refine your approach before risking real capital.